You want to know what platform to use and even what to invest in that platform. In this video, I'm going to go over whether you should invest in a robo advisor or just a normal brokerage and what accounts you should have in either of those types of platforms. So when you start investing, it can be very difficult to choose what you might want to invest in. If we look here, there are many different types of places you can invest in. And it's hard to really know what you should go with because you're thinking which one's going to be the best for me that's going to mesh well with what I want to do. If you want to be more standoffish, then the robo advisors are good ways to go. You can just honestly invest without thinking about it. You can check every 6 months, every year, maybe even more, and you should rest assured your money is growing. But when it comes to it being an investor, you usually want the most bang for your buck, and you want to grow your money at the most efficient way possible. And if you've read any articles or anything talking about these funds that are managed by real people, they can't even beat right here an S&P 500 index. They can't beat it. Mostly none of them beat it because it's just it's so well made, and it's not even really made. It's just the top 500 companies, but because of that diversification and how many there are, your your money's so well spread out, and the American economy is usually one of the strongest, that your money is going to grow at a good rate. It's an average between 7 to 8% a year, which you can't really find that anywhere. If you have a high yield savings account, you get at most of them 1% to 1.4, maybe if you find a good percent a year. And that's a year in a savings account. That's really not that much. So what you want to think about is what platform do you want to use and what do you want to invest in. So I'm going to go over all these platforms. Right here we have Betterment. Betterment is a robo advisor, so you can just invest money with them and they will take care of it for you. Betterment is good because they use Vanguard ETFs, and Vanguard ETFs have very good performance over the years. But the one catch with these robo advisors is they usually charge you a fee, and you don't want to pay a fee because if you know anything about ETFs, if you look up expense ratio. So this is the Vanguard 500. This is a 0.03 expense ratio. And when you're investing smaller amounts of money, you might not think it's a big deal, these small ratios, but it starts to add up because these are yearly. They take it off of your money. Even if you lose money, they are taking this off. So you don't want to pay too high of ratios. So Betterment charges you 0.25. VOO, if Betterment were to invest in that, charges you 0.03 on top of that. And then there's more ETFs Betterment invests in, so there are more fees. So that is not a flat rate. It can go up. Betterment is good though because it's a more hands-off approach. You don't have to think about it. You don't have to do research and know what's the best ETF and all that. You can just invest with them and they diversify your money. But they don't just do an S&P 500. They diversify your money across many ETFs, which are different markets or even real estate, or actually they don't do real estate on here, but different markets, bonds, all that stuff. They do many things. So your money might not grow as fast as an S&P 500, just normal composite. But that's a standoff approach. Same thing with Acorns, Robo Advisor. They charge you a flat fee though, which is good because once you start investing higher amounts of money, that flat fee is in fact better bang for your buck. But if you're investing smaller amounts, and I think in one YouTube video I watched by Graham Stephan, he talks about it needs to be like around $3,000, otherwise that dollar fee they charge you is is going to eat away at your profits, and you don't want that. So basically, you want to have more money in this. So if you don't have a lot of money, I mean, Acorns is still good, and if you'll get your money up to $3,000, then yeah, um, it's a good idea. But you get your investment account. If you want to do more and do an IRA, which I think in all of these you should do an IRA, but I'll get to that. It's $3 a month, so then you really want to make sure you have a good amount of money in there, because $3 a month really starts to eat away at your profits in the beginning when you're a smaller account. It takes longer to snowball. M1 Finance has another robo advisor, and I believe this one is free. And they also can help you make a portfolio, but they more ask you like, what do you want to put into them. But M1 Finance can just lay the groundwork for you, and they are a free robo advisor, so that's one thing to look at. But they don't have features that these two have, so it depends what features you like. Acorns is most famous for the roundup feature, which in my opinion, I don't really like the roundup feature. I had Acorns for a bit, and I would just use it as a normal investment account. I would just deposit money. I wouldn't use roundups. So it's good if you have more money. And then you have more traditional brokerages like Fidelity, Vanguard, which are the lower expense brokerages that are the most famous for having good funds, good returns. Now, and then also you can have just a normal standalone brokerage trading platform like Robinhood. So before you choose which one you want to do, you want to know what type of account, because there's multiple accounts. There's normal trading accounts, and normal trading accounts are just accounts where you can trade funds and then just withdraw the money, and you're taxed on capital gains. When you start investing, you want to make sure you put this money away for a long time, and by a long time I mean basically to retirement. But with a Roth IRA, you put pre-tax money, and when you're in retirement, put in pre-paid or taxed money. Once you're in retirement, it's tax-free. So you're gonna save a whole lot of money with a Roth IRA. You can contribute $6,000 per year, and then that builds up every year, also while growing. The good thing about a Roth IRA is you can take out your initial principal penalty-free, but you can't take out the growings. But if you're doing $6,000 per year, if you ever need it as an emergency fund, which I don't suggest, but if it ever came to that and you need it for just like one-time thing, you can take it out. It's not locked away. The growth is, but your principal is not locked away. And if you were to take that out, I suggest you put it right back in. You can't like double it up for the year. So if you took out 6,000 and then you try to put in 12,000 one year because you took it out, you can't do that. But if you were to do that, I recommend you just that year you make sure you do a full 6,000 again, so your money can keep growing. You don't want to ever slow down the process of your Roth IRA growing. So Betterment has a Roth IRA. Acorns has one, but as we saw, it's a higher fee. But it's a flat fee. That's why theirs doesn't go up, because Betterment is the 0.25 that we talked about, and then the other ETFs stack on top of that. You can start to get more once you start to make more money. The Acorns has a flat fee, but you have to have a significant amount of money for this to be worth it. M1 Finance might be good, but they don't have the same features. So Fidelity has good funds you can invest in, and you can start a free Roth IRA with a $0 minimum, which is great because a lot of us don't have a ton of money when we start investing, maybe a couple hundred, maybe even like $1,000, uh, and we want to start investing and growing it. That's a great thing, but some platforms like Vanguard have $3,000 minimums. It doesn't say it, but they have $3,000 minimums on a lot of their funds you might want to invest in. And it's just hard for younger investors with not a lot of money to get started with a company like Vanguard or the other ones that have like $500, $1,000 minimums to get started. It's hard. That's why Robinhood is so popular. That's why Fidelity is so popular, because the fees, there are no fees and there's no account minimums, so it's nice to trade with these platforms. So no matter what you choose, Robo Advisor, normal account, you're probably thinking, what do I put inside of it? First off, I think you should do a Roth IRA no matter what you do, because you'll get the tax-free benefits in retirement. It's the best account to start. It's the best account to start, so you can do 6,000 a year. It's your best bet. But what do you want to do inside of it? Personally, I think if you're young, if you're a younger investor, just go with an S&P 500 fund, ETF, index fund, whichever one you want, and just put your money into that. Now, maybe that won't apply to you because you have different risk tolerance, but that's what so many investors suggest. So personally, I would just, well, that's what I do, is I have a good chunk of my money in a Roth IRA that's going just towards a S&P 500 ETF, or you can do an index fund. And even when the market is down, like it is now from its previous high, it's always come back in stock market history. It's always come back. The only downside is if you buy around the high, then you wouldn't have made your money back, but it's always come back, so you'll eventually make your money back. What you want to do is you want a dollar cost average and buy shares every month. So then it evens out because you buy shares at lower prices. And then you want to just keep investing to the point where you get to a point in your life where you can do $6,000 in your Roth IRA, and then you can make separate accounts. Like you can do maybe a Robinhood account, or maybe just another, maybe you can do a Robo Advisor once you fill out your Roth IRA. You can just, keep continuing investing, keep growing your money, and keep uh, benefiting from, the market growing. And that's the whole point of investing, is to take advantage and grow your money.